Was that you, Amanda?
Hmm? No, that wasn't me.
Oh, it must have set it up to
It
do.
popped up, so I just hit got it.
Okay. Good morning, everyone. Thank you for joining us today. We're just going to give it a couple of minutes. We have a lot of people still joining us. We had over 300 people registered for this session or for these sessions. And right now, the numbers keep climbing. We're at about 160. So I think we'll get a few more. But we'll get started in just a couple minutes with the formal program. We will be using chat today, so if you have anything you need to ask us, just you can throw it in chat, and I'll bring that up again in a few minutes. Okay, well, it's 9:02. We have a lot of good information to give everybody, and I know we'll have people continue to join us. We're getting close to that 200 mark already. Really quick, so I'll get to some of these chat questions in a little bit after I do our introductions. So once again, thank you everybody for joining us. I'm Julianne. I'm the director of the UC Davis Retiree Center. I have Amanda Seta here with us, who is the assistant director. And we also have a program coordinator, Larry Tao, who is out on baby bonding for a couple of months. We're missing him, but we're excited that he gets to do that. We also have a part-time student, Sashi, who is very beneficial to our office and helps us do a lot of things. So those are the people that if you contact the Retiree Center, you'll get one of us. So just really quick about the Retiree Center, our goal is not only to do what we're doing today, educate our employees about retirement, but also in retirement, we become your home base. Um, Currently that would be your home department, but once you retire, we're really sort of your home for UC Davis. And when you need something, we are the best resource for you to call and we can direct you to the right place. We also plan trips, we do events, we have host coffee socials. We do a lot of things to keep our retirees involved with the university. Because, for a lot of people, they retire and they sort of like, what am I going to do with my time? And session 4 is really going to help you with that information on what to do with your time. But it's something we try to do to keep people involved, and you meet new friends, and you get to meet all of us. And anyway, there's lots of great things that we do at the Retiree Center before you retire and after you retire. So we hope that you'll continue to stay involved with the university when you do retire. So I'm going to move on to really quick. I want to introduce Sudesh Prasad from Benefits. He's going to be one of our panelists and be on all of these sessions with us. And Don Goldberg is our presenter today, and he's going to give you a lot of information, and just keep in mind that this information, I'm going to send it out to everybody next week with some links that he may refer to today and just general information. So you're going to receive all of this next week along with the recording of today's event. So with that, I'm going to turn it on over to Don. And I want to thank him again for doing this. He does such a great job, and people really feel like they learned a lot after his presentation. So thanks, Don, for being here.
Oh, yes. Thank you, Julianne. Good morning, everyone. I'm Don Goldberg from Benefits. And we got a lot of great information, a little housekeeping stuff. We will have a break in the middle. And any questions that you do have, please submit them in chat. And at the end, we will have some time for Q&A. I will cut off my video as I present, but I will magically reappear for the Q&A. And with that said, there's a lot to go over and I will get started. So today I'm going to be talking about the UC retirement plan. We'll talk about the monthly retirement income, the retirement payment versus the employee paycheck. And I think this part is enlightening, and there's a lot of good stuff that you won't find in the handbook. So I think you'll get a kick out of it, appreciate that part. We will go over the lump sum cash out, other sources of retirement income, retiree health benefits. That's going to be done next week by Garen Solbach. So please attend next week. That's very, very important. And I will talk about the retirement process. And once you are retired, there are, I would say if you ever want to attend future webinars at UCNet, you could find these webinars, the UC Retiree Health Benefits, as well as the UC retirement process from start to finish. Okay, so your UCRP benefits depend upon your membership. We have the 1976 tier. And that is a common question. What tier am I in? If you were hired to a UCRP eligible position before July 1st, 2013, you are in the 1976 tier. We have the 1976 tier coordinated with Social Security and not coordinated with Social Security. And pretty much everybody is coordinated with Social Security. For those who were here prior to 1976, they had a choice of paying into Social Security or not paying into it. But those who came after 1976 are in Social Security, except for our safety tier members. They do not pay into Social Security. We now have the 2013 tier, the 2013 modified tier. Then in 2016, they created the 2016 tier. And we also have multi-tier members. Those are people who are in two different retirement tiers. And I often say all these retirement tiers bring us retirement counselors to tiers. Okay, so eligibility for UCRP retirement benefits, you have to be in a UCRP eligible position, you have to work 50% time for a year or more. For those in the 2016 tier, they do have a choice. You have to choose the pension option. It takes 5 years of service credit, which we'll go over service credit shortly, to be vested. Vested means entitled to future retirement benefits. If you are in the 1976 tier, the 2013 modified tier, or safety tier members, the earliest age you could retire is age 50. If you are in the 2013 tier, the 2016 tier, the earliest age you can retire is age 55. So we have inactive members, and that will come into play later when I talk about the inactive cost of living adjustment. But an inactive member is somebody who is vested, they have 5 years of service, but they did not retire when they separated from UC. They are called inactive members. So important date. First one is separation date. And the separation date is your last day of employment. It can be a work day, a sick day, a vacation day, a leave of absence. It could be a weekend, but the separation date, you are actually an employee on your separation date because that is your last day of employment. Once you separate, then you could retire. The retirement date Separation date precedes the retirement date, and the retirement date is the day where your retirement benefits begin. So our pension program is a IRS qualified defined benefit plan, and it is based on three factors. It's a formula. It's based on our age when we retire, how many years of service credit, and our highest average plan compensation, our salary component. So the age factor times the service credit times the HAPC gives us what is called the basic retirement income. Now I'm going to talk about the age factors. And if you are in the 1976 tier, the 2013 modified tier, again, the earliest age you can retire is age 50, and your age factor is maximized at age 60. If you are in the 2013, the 2016 tiers, the earliest age you could retire is age 55, and your age component is maximized at age 65. The higher the age factor, the higher the monthly benefit. If you are a safety tier member, firefighter, or police officer, you would be entitled to 3% at age 50. Service credit. Service credit is earned based on actual time on pay status in a UCRP eligible position. If you are not on pay status, you are not earning service credit. If you are on a unpaid leave of absence, there is something called a service credit purchase that will allow you to buy back the time that you were on a approved leave. Very common question we get is, what will happen to my sick leave and my vacation time when I retire? So if you retire, your unused sick leave will convert to service credit if you choose the monthly retirement income option. All hours are accounted for, and it's your unused sick leave hours. That gets divided by 2,000, and that will be the increase in your service credit. It doesn't change your separation date. It doesn't change your retirement date. It is just added on when they do the calculations. Vacation, unused vacation at comp time and PTO is paid out on your final check. So in summary, sick leave converts to service credit when you take the monthly income. Vacation is paid out on your final check. Next, we're going to talk about the salary component, the HAPC, and we use your highest average consecutive 36 months. For most people, it's your last 3 years, but it doesn't have to be. It's your highest average consecutive 36 months. So if you worked here 25 years and years 18, 19, and 20 are your highest earning years, that is what we will use. If you ever take a position that pays less than what you're making now, we will always use your highest consecutive 36 months. So your HAPC can never go down. How do we calculate the HAPC? It is based on the full-time equivalent pay of your regular appointment, which basically means if you work 70%, 50%, 80%, we calculate it as if you are working 100% time. So if you ever go from 100% to 50%, we will still calculate the salary component based on the full-time equivalent 100%. What's included in the HAPC are administrative stipends and shift differentials. What's not included in the HAPC are overtime, summer salary, and negotiated annual additions. Being that we are a IRS qualified defined benefit plan, the IRS limits how much compensation we can use towards the pension program. So if you were hired here before July 1st, 1994, you could only use $520,000 per year towards the UCRP pension benefits. If you were hired after July 1st, 1994, and before July 1st, 2016, currently we could use a maximum of $350,000 towards the pension benefits. If you were hired in July 1st, 2016 or later, there is something called a PEPR limit. PEPR is Public Employee Pension Reform Act limit, which is currently 155,081. These limits do change year to year. There are some adjustments to the HAPC. For those in the 1976 tier, there is a reduction of $133. You don't ever have to figure this out yourself because when you do go to the UC Ray's retirement estimator, that's already calculated in. Although there is the temporary reduction of 133, there is a Social Security supplement that restores this reduction until age 65. So I mentioned earlier there's inactive members. Those are people who left UC, but they did not retire. So now I'm going to talk about the first of the cost of living adjustments. So if you've been around UC for a while, you often hear that July 1st is the best time to retire. And I would say that is true because of the cost of living adjustments. And you hear about you got to miss a day because to get this cost of living adjustment. And that would be true. And this applies to the 1976 tier and the safety tier members. So if you are retiring July 1st, you have to be inactive as of June 30th. So your last day on pay status would be your separation date would be June 29th. So what happens with that is if you are inactive one day, you are eligible for what is typically 2%, the inactive cost of living adjustment. So again, this is for the 76 tier and safety tier members. If you are retiring July 1st, you have to miss one day of work and then you become inactive and then you are eligible for the inactive cost of living adjustment, which is typically 2%. Now, I always say this probably doesn't make a lot of sense to people. Why does UC give us this 2% inactive cost of living adjustment because we miss a day of work and we retire July 1st? And I would say this isn't really for us. These are for inactive members. These are people who worked for UC for years. They are vested, but they did not retire. Say they left at age 45 and they wanted to retire at age 60 because that's when their age factor would be maximized. If we did not have this inactive cost of living adjustment, their pension would be greatly devalued over those 15 years. So what they do is every July 1st, there is this inactive cost of living adjustment, which increases the HAPC, which increases the benefit, and therefore keeps their benefits current with inflation. Now, for us, and I would imagine everybody here is an active employee, we can take advantage of this and we could benefit from this inactive cost of living adjustment by missing one day of work, becoming inactive, and then retiring. So this is a very common thing that we all do for the most part. For the most part, most people system-wide at UC do retire July 1st to benefit from the cost of living adjustments. And this is part one of the cost of living adjustments. Later, I'm going to talk about the retirement COLA. So there are limits to our pension program. So if you are in the 76 tier or the 2013 modified tier, you are entitled to 100% of your HAPC if you are the age of 60 or over and you have 40 years of service or more. If you are in the 2013, 2016 tiers, to be eligible for 100% of your HAPC, you must be age 65 or more with 40 years of service or more. Safety tier members can be eligible for 100% of their HAPC at age 50 with 33.34 years of service credit. Also, the IRS limits how much a pension program can pay out. So they do limit the total benefits payable from a pension. So say, for instance, the maximum that could be paid out through a qualified plan is 350,000 and you've earned 400,000. So what would happen is if you've earned the 400,000, 350 would come from UCRP from the pension program, and there is what's called a 415M restoration plan that would pay that difference between the 350 and the 400. Doesn't affect a lot of employees, but it does affect some. Now I'm going to talk about the monthly retirement income. So screen I debated about eliminating but I didn't, because you never have to do these calculations. But in this example, we have somebody in the 76th tier who's age 60. If they work here 20 years, they would be entitled to 50% of their HAPC. And in this example, their HAPC is $8,333. There's a Social Security offset, so therefore it's $4,100. But then there's a supplement that restores this offset, and their total benefit would be $4166.50. So if you didn't understand it, don't worry about it because you never have to manually calculate this. And we got more calculations for you. So if you're in the 2013 tier and you're age 65 and you got 10 years of service credit, you would be eligible for 25%. If your HAPC was $8,333, you would be entitled to $2083.25 as your basic retirement income. Mentioned that that is how you calculate it if you ever want to calculate it manually, but I wouldn't recommend it because we do have this UC Raise website. At the UC Raise website, you can find your membership details. Your membership details will show you what retirement tier you're in, if you have a CAP account or not, and I'll talk about the CAP account later, and it will show your health and welfare service credits. Probably the most important button in the UC Raise website is that one in the middle, the retirement one. When you click on retirement, this is where you can create your retirement estimates. And when you are ready to retire, this is where you would initiate and elect your UCRP retirement benefits. Everything is done at UC Raise, and this is a very, very important website to be familiar with if you're not familiar with it right now. So when you do go to the UC Raise website, they will give you 3 random estimates. And usually they are, well, not even usually, they are always 5 years apart. In this example, it is age 53, 58, and 63. They will show you your monthly benefit if you're under the age of 65, your temporary Social Security supplement, and if you have a lump sum cash out option, the lump sum cash out option payment. What I think is very important about this right here is what it's showing you is the basic retirement income. The basic retirement income is the income that provides you, the UC retiree, the most money on a monthly basis. If you are in the 1976 tier or a safety tier member, if you chose the basic retirement income, your eligible survivor would automatically receive 25%. Now, with that said, you may want to provide more than 25% for your eligible survivor, your contingent annuitant. And if that's the case, you're not going to choose the basic retirement income. So these numbers here that you're looking at are kind of deceiving because of the fact that that's not an option that you are going to choose. So what you want to do is you can create your own retirement estimate. And when you create your own retirement estimate, you put in the retirement date, the separation date, and you could name a contingent annuitant. And I'm going to show you some real life examples of that momentarily. So next, I'm going to talk about the retirement payment versus the employee paycheck. And I think this is a very important section to understand because when you do create your retirement estimates, you'll look at them and the odds are, in probably every case, that you are making more money right now as an active employee than you will be as a retiree. But that is only part of the equation because when you are an active employee, we have a lot of deductions that come out. And I am going to go over those deductions right now. So when you're an active employee, you have federal taxes come out, state taxes come out, I guess local taxes somewhere may be coming out. You have Social Security that will come out, that is 6.2%. You have Medicare come out, that is 1.45%. You have health benefits come out. You have your contributions towards the pension, towards the retirement, UCRP contribution. That could be 7%, 8%, 9%, depending upon your retirement tier. You may have commuter costs, parking, other work-related deductions, as well as a plethora of other deductions such as short-term disability, long-term disability, legal, life insurance, dependent life, accidental death. We have many deductions, I'm sure you all know, that come out of our paychecks. And the good news is when you retire, pretty much all those deductions go away. When you retire, you have federal tax. That's the one thing that I would say will not go away. You have state tax if you live in the state of California. But if you by chance move out of the state once you retire, you can choose to not withhold California state taxes. You will potentially have the cost of your health care come out, but there are certain instances when you have a certain amount of service credit and you have Medicare that there can be potentially no cost for your health insurance as a retiree. So this is the reason why I think this is a very important screen, because when you are looking at your retirement estimates at UC Rays, that's the gross, but it is possible because we don't have all these deductions that you could potentially take home more money in retirement than you do when you're currently working, depending upon how many years of service credit you have. So I mentioned earlier the inactive cost of living adjustment. That's for those in the 76 tier, safety tier. That's when you retire July 1st and you separate. You have to miss one day of work and you separate at the end of June, and that qualifies you for the inactive cost of living adjustment. Now, part two of the cost of living adjustments, excuse me, is the retirement COLA. And every July 1st, there is a retirement COLA for those who are retired 1 year or more as of July 1st. So that is a part two of why people do retire July 1st. One, to benefit from the inactive cost of living adjustment. And because they retired July 1st, they would be eligible July 1st of the following year. In this case, if they would have retired July 1st, 2026, they would be eligible July 1st, 2027. If by chance they retired after July 1st, which probably in almost all cases would not be a great idea, then they would then have their first COLA would be July 1st, 2028, because July 1st, 2027, they would not be retired one full year or more. So I know typically when we do these presentations, cost of living adjustments, I would say is the most confusing part of the whole presentation. So if you're confused, you're part of don't worry about it. That's pretty norm for the situation because it is kind of confusing. Inactive COLAs, retirement COLAs, but hopefully I explained it in a way that it is somewhat understandable, and we will have time at the end, if needed, to go over it during the Q&A. Now we're going to talk about, I'm going to call it the death death portion of the retirement. Payment continuations after death. We have the post-retirement survivor continuance. We have the contingent annuitant option that is named at the time of retirement. We have the pre-retirement survivor income, the lump sum death payment. And for more about that information, you could always find out more about the survivor benefits at UCNet. There's publications, and I'll go over each of these. And we have the post-retirement survivor continuance. I always call it the eligible survivor amount. So when you choose the basic retirement income and you are in the 1976 tier and a safety tier member, automatically, I'll go to the next part. Automatically, for those paying into Social Security, 25% will go to your eligible survivor. There is no reduction for this benefit for those in the 76 tier and safety tier members. So if you choose the basic retirement income, the highest benefit available, then automatically your eligible survivor would receive 25%, no reduction to you. If you want to leave more than 25% for somebody, your eligible survivor. But before I get into that, that's called the contingent annuitant. Let's clarify what an eligible survivor is. So an eligible survivors will be the following. First and foremost, it is a spouse or domestic partner. And a spouse or domestic partner qualifies as an eligible survivor if you were married or partnered at least 1 year or more prior to the retirement date. So that is the first eligible survivor, the spouse or domestic partner. If you do not have a spouse or domestic partner, children can be eligible survivors if they're under the age of 18, 22 if they're a full-time student, or if they're an adult disabled dependent and the disability occurred before they were age 18. If you don't have a spouse or domestic partner or children, you may have a dependent parent. And a dependent parent would qualify if you provide 50% support or more, and they would be eligible for that benefit. So the order that it's paid out is first to a spouse or domestic partner, if none, children, if none, dependent parents. Common question we get is, can I make the children an eligible survivor? And it may be, you may love your children a lot more than that spouse or domestic partner, but there is no flip-flopping of the order of which this is paid out. This is dictated by policy. So now we're going to talk about the contingent annuitant option. And what I just talked about was built into the program. You don't choose, you either have them or you don't. At the time of retirement, you can name a contingent annuitant. And if you name a contingent annuitant and you pass away first, they would receive a monthly income after your death. A contingent annuitant can be anyone, including your spouse or domestic partner, and then they would receive both benefits. And going back to the first two bullet points, it may sound good. Yeah, hey, if I pass away, why not give somebody a monthly income for the rest of their lives? The problem potentially is it reduces the amount that you would receive on a monthly basis. Now, how much will it be reduced? You would want to go to UC Rays and you could create estimates to show exactly how much it would be, but the reduction is based on your age and the age of the contingent annuitant and the option you choose. So the younger they are, then the more the reduction will be. And depending upon the option you choose, the more you give to the contingent annuitant, the more your reduction will be. By chance you name a contingent annuitant who is not your spouse, and there is a age gap of 10 years or more, some of the options may be limited, and the Retirement Administration Center, they'll have to do what is called an MDIB test, minimum distribution incidental benefit test, because basically the IRS requires that you take a certain amount of your pension. You cannot pass the pension on to your grandchild or whoever it may be, because the IRS requires that you do take a certain minimum, so certain options may not be available. Once you do make this election, it is irrevocable. And I'm going to get into this in greater detail once we look at the estimates and the numbers. If you do name a contingent annuitant, we would need birth evidence for the contingent annuitant. That would either be a copy of a passport or a copy of a birth certificate. Okay. So this screen, I'm going to say I like, because this is where all the theories and all the concepts come together in a kind of real life example, but it's not a real life example because these are just hypothetical numbers. So going from left to right, we have the monthly retirement income, we have the basic retirement income. And again, the basic retirement income is the income that provides you, the UC retiree, the most money on a monthly basis. If you are in the 1976 tier, safety tier, then your eligible survivor amount is 25%, no reduction to your basic retirement income. So in this case, they named their spouse or domestic partner contingent annuitant. So there's options A, B, C, and D. And keep in mind, this is a estimate. So I wouldn't worry so much about how the numbers look or not look. What's going to be important as I go over this is the concept of how it works. So we have the various options from left to right, and then we have the lifetime monthly payment to you. So in this case, the basic retirement income is $24.33. If they chose option A is the option that provides the greatest benefit for the spouse or domestic partner. And if they chose option A, instead of getting 24.33, they would receive 22.19. If they passed away first, their spouse or domestic partner would get the same amount. They would get 22.19. They would get the 608 plus the 1611 equaling the 22.19. Now, I would say this is just an estimate. In this example, it's just a $200 deduction between the 2,400 and the 2,200. But this reduction can be thousands of dollars depending upon your income. I've seen in one retirement where the reduction was from 18,000 to 12,000. It was 6,000 a month to provide a contingent annuitant benefit. So again, these numbers are hypothetical, but how it works is important. And then we got options B, C, and D. And basically, the more you provide to the contingent annuitant, the more your reduction will be. And to me, I always say this is by far, I would say for most people, the hardest decision to make. Most people know if they're going to take a monthly benefit or a lump sum cash out. The hardest part for most people who do have a spouse or domestic partner is choosing which option would be the best option. A common question will be is what happens if I chose option A and my contingent annuitant passed away? And what would happen is it is irrevocable. Once you make this choice, it is irrevocable. And I could tell a story back when I was in my prior life. I was in the Retirement Administration Center and I was a supervisor. And I remember that one time somebody said, "Hey, I want to transfer a call to you." I dealt with complaints all day. And I have somebody who's very, very mad because they retired and they want to make changes. And I said, okay, put them through. And basically what happened was the person retired and he named his fiance at the time contingent annuitant. And unfortunately for him, it did not work out and he wanted to make changes. And I basically had to say, you can't. So he was mad and he was going, I mean, I have to live on $500 a month less for the rest of my life. And I basically said, yeah, that's how it works. And if I die, she's going to get a lifetime income for the rest of her life. And I said, yeah, that's kind of how it works. And then it hit me. I said, there is one way that she won't get anything. And then yeah, how does that work? And I said, well, if you live, she doesn't get anything. So you just gotta live at least one day longer than her, and she will never receive anything. So, in my opinion, that probably is the silver lining of this bad situation because now he has a reason to live. This guy is probably at the gym as we speak, working out, either running in around the block, walking, and he's living his best life and he's going to live many years longer just to make sure that the ex-fiance at the time does not receive this money. So it is very important to remember that it is an irrevocable decision and probably the hardest decision to make. Now we have another example, and this we would say is there is no eligible survivor. It could be the 1976 tier where there is no eligible survivor, or it could be a 2013, 2016 tier. And basically, the same concept. You have the basic retirement income, in this case, same 2433, and you have three contingent annuitant options, A, B, and C. And in this case, if someone chose option A instead of getting 2433, they would get a reduction to 2148. If they passed away first, the contingent annuitant would get 2148. If the contingent annuitant passed away first, the retiree would be still getting 2148 because it is irrevocable. Then there's options B and C. And again, the more you provide to the contingent annuitant, the more your reduction will be. So this is why I would say you don't want to wait if you are thinking about retiring until 3 months before you're ready to retire to get your personal retirement profile. I would highly recommend going to UCRay's, creating your retirement estimates, and looking at all these numbers way in advance of your actual retirement. Okay. So running the estimates, here we are, got it. So if you want to create a retirement estimate, you would click on this button, and that's how you do it. Going back again, as we talked about earlier, if you want to create retirement estimates, you go to UC Raise, click on create a retirement estimate, and basically there's three things you would need to input. You would need to input the retirement date, the separation date, and if you want to name a contingent annuitant, you would name your contingent annuitant in the spot for contingent annuitant, and then you would be able to create an estimate. Okay. So death prior to retirement, death while eligible to retire. I'm going to say this is a very, very, very important benefit to know because I'll get into that momentarily, but many people don't understand this benefit and probably shouldn't because people aren't thinking about this. But death while eligible to retire is, first of all, we'll talk about what eligible to retire is. So if you are eligible to retire, that means you are either age 50 or more or 55, depending upon your retirement year, and you have 5 years of service credit or more. So if you were to pass away, say, for example, June 15th, then UC would put the retirement into effect as of June 16th, and your spouse or domestic partner would get the highest benefit available, which was option A. And I'll just toggle back a few screens just to bring back what option A is. So if there is a death while eligible to retire, again, UC would put the retirement into effect the day after the death, and they would receive option A, which is the highest benefit available. And I think why this benefit is so important to know about is we have a lot of employees who work here many, 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 many years, and sometimes they think that I may need to retire because I really don't want to retire, but I want to make sure that if anything happened to me unexpectedly, that my spouse or domestic partner would be taken care of. And I would say you don't have to worry about that because if you do have a spouse or domestic partner and you were to pass away before and you didn't make any retirement decisions, under this provision, death while eligible to retire, they would receive the highest benefit available. Then there is something called pre-retirement survivor income. And pre-retirement survivor income means they're either not the age of 50 or 55, or they didn't have 5 years of service credit, but a minimum of 2. So if they passed away and they qualified for pre-retirement survivor income, they would get a percentage of their salary depending upon their retirement tier. And let's see, that would be payable to the spouse or domestic partner starting at age 60, but it can be paid out earlier if there are children under the age of 18, 22, if they are a full-time student, or if there is an adult disabled dependent. So that is pre-retirement survivor income. That one is, for the most part, is pretty rare, but it does occur system-wide that people do pass away and qualify for this pre-retirement survivor income benefit. What did I do? Then the last part of the death portion of our retirement program is the basic death benefit. And this is a one-time payment of $7,500 to your beneficiaries. It is a taxable benefit, and you would designate your beneficiaries and can change your beneficiaries anytime at the UC Raise website. So next I'm going to talk about the UCRP pre-tax and after-tax contributions. Since 2010, we all contribute to the UCRP program, our pension program. prior to 1983, well, let's go back. We contribute on a pre-tax basis. Prior to 1983, we used to contribute on a after-tax basis. These UCRP contributions help fund the retirement benefit. When you go to the UC website, you will see your UCRP contributions. And people, I would say, I got this question a lot back in the day. They would see this figure 125,000, 78,000, whatever that number is. And a lot of people thought that was a pool of money that they were entitled to, but that is not the case. It is not payable separately upon retirement. You will either get a monthly benefit or a lump sum cash out, but you will not get your UCRP contributions. It is held in a separate account because any unpaid contributions are refunded to your beneficiaries upon death. And basically, what that means is, say, for instance, and this is pretty rare, but if you've contributed 200,000 towards the pension, and in total 150,000 was paid out, and you passed away, and there were no survivors, we'll say in this example, you contributed 200, 150 was paid out, then that unpaid contributions would be refunded to your beneficiaries as listed at UC. What I just talked about was the monthly retirement benefits, including the survivor benefits. What I am going to talk about next is the lump sum cash out option. What the lump sum cash out option is a one-time payment in lieu of a guaranteed lifetime benefit. So this is a very, very important decision. Most people tend to take the monthly benefit, but there are instances where some people do take the lump sum cash out. I typically see that the most when we have two UC employees. One takes the monthly benefit and the retiree health benefits. The other one may potentially take the lump sum cash out. The lump sum cash out is only available to those in the 1976 tier, safety tier, and the 2013 modified tier members. So when you do take the lump sum cash out, it is important to remember that you do forfeit the following benefits. You forfeit eligibility for retiree health benefits, the basic death benefit of $7,500, and there are no survivor benefits. Also, when you take the lump sum cash out, sick leave is not converted to service credit when they do the calculation. Those who were thinking of coming back after retirement, there are more restrictive return to work rules for those who do take the lump sum cash out. If you do take the lump sum cash out, you would, I would say in almost every case, would want to roll it over because if it was to come to you directly, it would all be taxable in the year in which you took the payment. So you can roll it over, and you could roll it over to a qualified retirement account, including the UC retirement savings programs, other qualified employer retirement plans, a IRA or a Roth IRA. In the cases outside of the Roth IRA, if you were to do a rollover, it would defer the taxes and that lump sum cash out would not be taxable until you took it out. Once you do take the lump sum cash out, that decision is irrevocable. And I would say this too is being in the business that I'm in, I've seen many people over the years take the lump sum cash out and unfortunately regret it. We often hear about people winning the lottery, winning millions of dollars, and in a few short years, that money is gone. That works the same for a lot of people who do take lump sum cash out. So you really, really want to be careful. if you are considering the lump sum cash out, because the monthly benefit will never run out. It is a guaranteed for the retiree lifetime monthly benefit. A lump sum cash out is a one-time payment, and then you have the job of making sure that that money lasts a lifetime. Okay, so let's see what time it is. We're gonna take a break, and I will say we will reconvene at 10:10.
Thanks, Don. We'll see everybody back in about 14 minutes.
Yeah,
Thanks so much.
thank you. Okay, welcome back. I would say we're heading towards the home stretch. I think if I would say the most confusing part, hopefully it wasn't too confusing, or the more complex part was the first part that we just went over. Now we're going to talk about other sources of retirement income, and we'll also talk about the retirement process. But now we're going to talk about other sources of retirement income, which can include the capital accumulation payment, the retirement savings programs, a little bit about Social Security, as well as other retirement systems. So the capital accumulation payment, these were special allocations to UCRP members in the early 90s, early 2000s. For those who were around back in the day, those years there were not pay increases and the UCRP plan was very well funded. So what they decided to do was put some money into what was called the Cap 1 in the early 90s. And then when there were no pay increases in the early 2000s, they created a Cap 2. The Cap 1 and the Cap 2 get a very, very good annual interest rate. But when you do retire, you do have to take a distribution. You could either have it come to you and then it would be taxable, or you can roll it over. The cap account is usually paid out at the end of the month in which you receive your first paycheck or pension check. So if you were to retire July 1st, and we'll say you're going to get a first pension check of August 1st, typically the cap will be distributed at the end of August. Now we're going to talk about the retirement savings programs from an employee perspective. First, we'll talk about the DCP, defined contribution plan. Now, currently, if you wanted to contribute to the DC plan, you could do so on a after-tax basis. If you were working here between the years of 1990 and 2010, there were mandatory pre-tax contributions in lieu of contributing to the pension program that went into our DCP plans. If you worked safe harbor or you are getting a DC supplement or in the DC savings choice, you will be contributing to the DC plan, defined contribution plan. Currently, the contribution limit for 2026 is 72,000 with all sources combined. We also have the ability to contribute to a 403B and a 457B on a voluntary basis, no UC matching, either on a pre-tax or after-tax basis. Currently, the 2026 deferral limits are 24,500 for those under the age of 50. For those over the age of 50, there is an additional catch-up provision of 8,000. And you actually have the ability for those who have the financial bandwidth where you can contribute to the maximum of both the 403B and the 457B plans. Oh, and also for those over the age of 59 and a half, you do not have to retire to be eligible to take money out if you wish to do so, because if you are 59 and a half or older, there is something called an in-service distribution, which allows you to take out the money as a active employee. So now I'm going to talk about the retirement savings program options after you retire. After you retire and you are no longer receiving pay as an active employee, contributions will stop. You have a balance of over $2,000 or more at the Fidelity accounts. When you retire, there isn't any required actions that you need to do, because if you have a balance of 2,000 or more, everything can stay as is. When you're retired or over the age of 59 and a half, you can set up a systematic withdrawals, or you could take out money as you wish on a time by time, one time basis. You'll always have the ability to manage your investments as to where your investments are allocated. You could roll money into or out of the plans. If you have other qualified retirement programs and you want to roll it over to Fidelity as a retiree or as an active employee, you will be able to do so. And you'll be able to manage your accounts and as well as name your beneficiaries for your Fidelity accounts at the Net Benefits website. So when you're retired or taking an in-service distribution, and if you contributed money on a pre-tax basis, it will be taxed as income once you receive the money, unless you put money in on an after-tax basis or as a qualified Roth distribution, because it was already taxed to begin with, it would not be taxed again. Again, you'll be able to roll over plans to a qualified retirement plan or into the Fidelity plan if you wish to do so. If you leave UC and you are, we'll say, under the age of 55, there can be a early withdrawal penalty. However, if you are taking money out of the 457B plan, the 457B plan never has a early withdrawal penalty. So if you leave UC, wish to take money out from the program, from the 457B, there would not be any early withdrawal penalties. If you wish to take money out of the 403B, we do have the 55 rule. So if you are over the age of 55 when you leave or separate UC, there is not a early distribution penalty. So unlike I'll call it the rest of the world, there is an early distribution penalty if you take money out before the age of 59 and a half. Because we are a nonprofit, we have the 55 rule in which we're able to take money out prior to 59 and a half, as long as we are over age 55. There is something called a required minimum distribution. So make believe you don't need this money and you like keeping the money there at Fidelity. The government says you cannot do that forever. At a certain age, typically at age 73 upon separation, the government says you have to take a required minimum distribution. Whether you want the money or not, need the money or not, the government says you have to take this money because this money was never taxed and they need to eventually tax it. So there is a required minimum distribution. Again, very important actually that if you are this age and retired, that you do take this minimum distribution. Fidelity will contact you and tell you when a required minimum distribution is due, because if you don't take it, there is a pretty severe penalty for not taking it as far as dollars and cents. It's not a severe penalty that they throw you in jail or anything like that, but there is a monetary penalty for not taking the minimum distributions. Okay, so there is this, I'll call it pretty new deferred limit income option. So at the age of 62, between 62 and 69, you have the ability to convert a portion of your retirement savings plan into a monthly annuity that starts at age 78. For more on this and about these annual purchase programs, you could do this, find out more information at My UC Retirement Income. The benefit I would say of this is instead of having to worry about how long your lifetime income will last, you could actually convert this into a monthly payment that would start at age 78, and it's a guaranteed payment once you annuitize your retirement savings programs. Next, I'll talk pretty briefly about Social Security. Most UC employees do contribute to Social Security. Social Security benefits can begin at age 62. You definitely want to reach out to Social Security for more information. You can see your Social Security estimates at ssa.gov. So that's important. We do contribute to Social Security. And when you're a UC Davis, or let's just say a UC retiree, your retirement income does not offset anything that you've earned from Social Security. So some employees who were hired before 1976, they had a choice of paying into Social Security or not. So if we do have employees who were here before 1976 and chose not to coordinate with Social Security, they have not paid into Social Security. Safety tier members, firefighters, police officers have not paid into Social Security, but they could still be eligible for Social Security benefits from another source, prior employment, maybe an ex-spouse. So if you're in that category, you would want to contact Social Security for more information. We do have retirement system agreements with CalPERS and with CalSTRS. With CalPERS, we have reciprocity, and to be eligible for reciprocity, you have to have gone from CalPERS to UC or UC to CalPERS within 180 months, and you have to fill out the forms. So you could be eligible by going from CalPERS to UC within 180 months, but if actually, let's take it back 180 days, 180 months, too long, 180 days. So if you went from CalPERS to UC within 180 days, you are eligible for reciprocity, but you do have to complete the forms to get this benefit. Also, with reciprocity, you have to retire from both CalPERS and UC, both retirement systems on the same date. So again, that is how you become eligible for reciprocity with CalPERS. With CalSTRS, we have concurrent retirement. And to be eligible for concurrent retirement, you must be an active UCRP member on or after July 1st, 2002, and you cannot retire from one system and continue to work in the other. The benefits of these systems are we share service for vesting purposes. And I'll say what that means in English is if you need 5 years to be vested and make believe you had 4 years at CalPERS, you would only need 1 year at UC to be vested. If you had 10 years at CalPERS and came to UC, you would be vested from day one. The biggest benefit I would say is let's use the example you had 10 years at CalPERS, you came here to UC for the last 20 years, and you're making more money at UC. So when you retire on the same date from both systems, they will use the highest salary in either system to calculate the benefits. In my example, you're making more money at UC, so they would calculate it for the 10 years you worked at CalPERS, and then in the end, you would get two checks, one for the 10 years that you worked at CalPERS, and again, they would use the highest UC salary when they calculated their benefits, and then you would get a separate check from UC the 20 years that you worked here. I am ready to retire. I put in my time. I am ready to go. What do I do now? The first steps are you attend UC retirement planning workshops and webinars, which you're doing now, and thank you for attending. You want to definitely go to UC Raise, review your UCRP estimates and retirement savings balances at Fidelity. You want to go to the ssa.gov to see what your Social Security benefits will be. You want to read the retirement handbook. I don't know. Yeah, you could read the retirement handbook if you want. You could call up your previous employers and see if you have any benefits there. This one I was waiting for. You can talk to a Fidelity workplace financial consultant. This I would highly, highly encourage. We have UC Davis dedicated Fidelity people who work for Fidelity, but they are contracted to work with our employees. And this is a very valuable service that is free of charge for our employees. And I would highly, highly take advantage of this because when you talk to a retirement counselor, they could go over their options with you. If you ask me questions, I could go over your retirement options with you. But when you talk to a Fidelity financial consultant, they could look at not only your UC retirement, they could look at other assets. If you have a spouse or domestic partner, they could look at their retirement. They could look at factor in Social Security, life insurance, again, other assets, and put together a overall financial plan that could determine if you're in great shape to retire, also as to potentially which retirement option you should choose. That can make a big difference. If you have a great financial plan and you're going to be okay, then you may be able to take the basic retirement income and not have to take a reduction to provide for a spouse, depending upon the situation and the overall financial picture. So it is highly encouraged to meet with the Fidelity Workplace Financial Consultant. Again, this is free of charge and they're great people and very knowledgeable. And consult with your tax or financial advisor when you're ready to retire. And you always want to ensure your personal finances are in order. Okay, so you decide you're ready to retire. Most people statistically will retire July 1st. So you will select your retirement date and your separation date. If you are in the 76 tier high before 2013 or a safety tier member, and you are retiring July 1st, remember you have to miss 1 day of work, and then you would qualify for the inactive COLA. And if you are ready to start the retirement process, you can initiate that at the UC Ray's website as of April 1st, within 90 days of the retirement date. I will say this too, when you are creating your retirement estimates, and if you are looking at July 1st, 2026, and you are in the 76 tier or safety tier member, they will not factor in at this moment the inactive COLA. So what I always do is when I do my retirement estimates, it's always July 1st, I always figured that I would be eligible for the inactive COLA, and I always add 2% to that. But if you are doing an estimate right now, it will not show, even if you put in a July 1st and a separation date, we'll say of June 29th, the inactive COLA at this moment. Okay. So for staff employees, you need to inform your supervisor or manager that you are retiring. For academic appointees, you need to inform your department, dean's office, or academic personnel office. If you are, again, an academic appointee, there are certain times during the year that you can retire. So you want to definitely reach out to the academic personnel office to know when dates that you would be eligible for retirement are. Okay, to initiate your retirement, there's basically two ways of doing it. And by far, I would say for the most efficient way is definitely to do it at UC Rays. You can log on to UC Rays and you create your PRP. Basically, you just got to put in your retirement date, your separation date. If you have a contingent annuitant, their name and their date of birth. And then you would be able to create your PRP or, oh, and I hope people don't do this anymore, but you can actually fill out a form rather than go online and get pretty much your personal retirement profile instantaneously. You could fill out a form that you could find at UCNet and then send it to the Retirement Administration Center in Oakland. And then they go through all these forms, and then they eventually send you your personal retirement profile. If you complete the form and you're missing any information, then you got the back and forth of them trying to get in touch with you to find out some information that was left off the form. So you definitely want to do it at UC Rays. I will say this, that during the retirement season, we have benefit help desks where I'm on it. Garen, Solbach, Sadesh, basically our UC Davis benefits team, the Fidelity representatives are there. And we're there periodically throughout the retirement season where you could come on to our Zoom meetings and ask any questions. So we'll be there as you go through the retirement process to answer any questions that you do have. Okay. So once you do get your personal retirement profile, you want to review the retirement options in your PRP. If you do have any questions, you could read the handbook or reach out to the Retirement Administration Center, as well as join our benefits help desk. And then once you've made your choice, you can go online to UC Rays and click the various buttons and make your elections, or going back to the manual process, you could complete a form, hopefully complete it correctly, mail it back to Oakland. Hopefully they input it correctly, and then they mail you out a election form for you to sign. So you definitely want to do it online, and we can help you with that if there's if help is needed. So to log on to UC Rays, once you've created your PRP, you would click on Initiate and Elect Retirement. It would give you your various options, and then you would make your various choices. You'll have the ability to electronically sign, and if you are married or have a domestic partner, your spouse or domestic partner also has to sign the retirement election. The following items would be required if you are naming a contingent annuitant. You would need to provide birth evidence, either a copy of a birth certificate or a passport. Most people are able to find the passport and usually submit that. If you are married, they would need marriage evidence, typically a marriage certificate. But if you don't have that, sometimes there are tax documents that are acceptable. Um, Basically, page 23 of the retirement handbook has a full list of all the acceptable documents. If there is a divorce, legal separation, termination of a domestic partnership, you will need to upload those documents, hopefully well in advance of your retirement, because if it's not done, that will cause delays in the processing of your retirement. Once all the required documents are in, the Retirement Administration Center will review your election documents. At the UC Rays website, you can see where you are in the retirement process and track your retirement. And when everything has been completed, you will get a confirmation letter that does not need to be signed, but it is very, very important that you do review it to make sure everything that you wanted is as is. Because up until your retirement date, or let me click, up until the retirement date or 15 days later after the date on the confirmation letter, you can make any changes, including the cancellation of your retirement. So as you go through the process, and if you have a change of heart, you will always be able to cancel your retirement or change the elections within the retirement up until the retirement date or 15 days after the date the confirmation letter has been sent, whichever is later. There is a UC retirement process webinar, the UC retirement process from start to finish, that can be found at UCNet. And now you've done it. You did it. You really done it now, and you are retired. So what happens when you retired other than have a great, happy, and healthy retirement? What to expect? Retirees get paid once a month on the first of the month, unless it's a weekend or a holiday, then it's the first business day prior. So you may be biweekly now, but retirees are paid the first of the month, once a month. Hopefully, you will have direct deposit. You will be able to see your benefit income statements at UC Raise. So right now, as an active employee, we see our paycheck stubs at UC Path. When you retire, pretty much everything switches from UC Path to UC Raise. You'll get your 1099-R tax form at UC Raise. The year that you retire, you'll probably have a W-2 and a 1099-R. So the 1099-R is the retiree tax form at UC Raise. The W-2 you will find at UC Path. You always want to keep your personal information up to date. At UC Raise, you could change your address, phone number, or email. You could change your tax withholdings, direct deposit information, beneficiary information. And every year, retirees have open enrollment, and you can make your health benefit changes at the UC Raise website. Also, at Fidelity, if you do have a change or need to change your beneficiaries, you would change your beneficiaries for the retirement savings programs at the Net Benefits website. Now, you are retired, but of course, we want you to stay connected. So you will get the always enlightening and very valuable New Dimensions quarterly newsletter. So that will be mailed out to you, keeping you abreast of everything that's going on at UC. So you can mark it down on the calendar and wait by the mailbox for that wonderful quarterly New Dimensions newsletter. Important websites will always be available to you. The UC Raise website, Fidelity, UCNet, and My UC Retirement will be available to you. But most importantly is local resources. Emeriti and Retiree Associations, the UC Davis Retirement Center, and we have healthcare facilitators, as well as Fidelity will still be the financial planning and guidance consultants. These are very valuable local resources that will always be with you as a retiree. So you have gone through the retirement process. You are now retired, and you didn't think this was going to happen, but you miss your coworkers. You miss the wonderful UC Davis campus and UC Davis Health, and you want to return to work after retirement. You didn't think it was going to happen, but it's happening. So you can do that, but you have to have a break in service of at least 30 days before you could return. Your initial appointment is limited to 12 months and 43% time, and you can continue to receive your retirement income with this return to work limited appointment. Okay, here it gets a little bit tricky, and Garen can talk about this next week. But if you return and qualify for employee health and welfare benefits once you are retired, your retiree medical plan enrollment will be suspended, and you may enroll into employee plans. This is a new rule that went effective July 1st, 2025. It's pretty new. But if you return to work within 6 months, then you may be eligible for employee plans and you will suspend your retiree medical plan enrollments. Yep. If you return to the UCRP eligible position, okay, so I'll first get into this. So there are two ways of coming back. You come back on a part-time basis, which was discussed earlier, limited to 12 months at 43% time. But now you're coming back, you really, really miss this place. You want to come back full-time, and you can do that as long as you did not take the lump sum cash out And if you come back into a position that is 50% time for a year or more, you would be UCRP eligible. And then at that point, you would suspend your retirement income and retiree health. You would then have employee health, and you would earn new service credit in your new retirement tier. And then you would re-retire. You would have your old retirement plus your new service credit, and you would re-retire the day after your position ends. Now that was complicated. If you are taking a lump sum cash out, as I mentioned, you cannot come back into a UCRP eligible position, but you could come back on a limited basis. Oh, and that does it. So now that was a pretty abrupt thing like the Sopranos. And now we'll open it up for Q&A.
Okay, thanks, Don. That was a lot of great information, and we've got some good questions also. So, my Q&A did pop up, so that was good, and we've got questions in both chat and Q&A. So I'm going to start on one. And some of the things I sent out like links, so for everybody, just there is stuff there that you'll want to copy, but also keep in mind next week after we get the recording done, I will send out the links that were in the session, a copy of the slides Don presented, and the recording. So all that information will be coming in a few days. So, first question. I will be 70 next year, but will only be here 7 years at that time. I was wondering if it's worth me waiting the 3 extra years to get my 10 years.
For that's a good one. That is such a personal call. It's a good one because once you're age 70, you would potentially, well, you would qualify for Medicare Parts A and B, and then there would be a need for a medical supplement, Medicare supplement, but you would have insurance. Again, you would have Medicare and just need a Medicare supplement. I don't know if it would be worth the 3 years to do that, but if you love working and you love your job and you're willing to do that, then there is the benefit of once you have 10 years of service credit, then you would be eligible for retiree health. And that is definitely a great benefit to have. But there's so much that goes into play if it's worth the 3 years or not. But I think that would be a good one for Garrett potentially next week.
I agree. I do think that's a good call. Um, so the next one for 1976 tier, inactive COLA. If I intend to retire on November 1st, do I still need to have 1 day of inactivity?
Right. Good question. Basically, that 1 day of activity only inactivity only applies to July 1st to be eligible for the inactive COLA. Because if you do retire in November, there is no inactive COLA. You don't have to, whatever your last day is, you could retire the next day. Because again, going back, the inactive COLA only applies on July 1st and it is awarded on July 1st if you are inactive as of July 1st.
So this
I,
is going to go
yeah,
ahead.
I would say there's a lot that goes into a retirement choice and November 1st, but potentially by retiring November 1st, you're giving up two COLAs. You're giving up potentially the inactive COLA, assuming you're in the 76 tier of roughly 2%. And if you were to retire November 1st, come July 1st the next year, there would not be a retirement COLA of, we'll assume, 2%. So by working August, September, October, maybe 3 additional months, you're potentially giving up roughly 4% in COLAs that may not be worth it.
And so this one is sort of ties right into that is if I retire in April or May, do I get the 2% adjustment by July?
And I would say no, no. What would happen there is if you did retire April, May, You would not be eligible for the inactive COLA that's awarded July 1st if you are inactive, because you're not inactive July 1st, you're retired. You would be eligible for the retirement COLA of July 1st, 2027, because you would be retired 1 full year or more. So the retirement COLA would still go into effect the following year, but you would miss out on the inactive COLA this year.
So if you are in the 2016 tier, there is no inactive COLA, correct? So if I separate at 62 and don't retire, I think what they're saying is, and I don't retire until 65, my HPAC, it's actually HAPC, right, will not have a COLA adjustment for the 3 years I was inactive.
Correct.
Okay.
Yes, that is true. What I would do is I would run the estimates at 62 and 65. And of course, 65 would be more because of the increased age factor, but then you're giving up potentially 3 years of income. So that it would be something to consider. Also, may not be applicable, but if you have 10 years of service credit at age 62, you would be eligible for retiree health. And to be eligible for retiree health, you have to retire within 120 days of your separation date. So if you were eligible at 62 and then decided to wait to 65, when you did retire or when you do retire at age 65, you would not be eligible for retiree health.
Okay, so we're going to jump into a little bit about survivor benefits and contingent annuitant. And I think more stuff came in from the questions we were just asking. So let me just scroll down to try to keep, let's see. What is the range in age? Okay, I'm going to keep going. Will your survivor benefits continue to your children if your spouse also passes after you?
So I'm assuming we're talking about the eligible survivor benefit. So if you are in the 1976 tier high before July 1st, 2013, if your spouse passes away, your children could be eligible for benefits if they're under the age of 18, 22 if they're a full-time student, or if they're an adult disabled dependent, then it would continue, they would be eligible for that 25%.
So somewhere in all these questions I was reading also, so I'm going to just sort of continue on this subject. So if the retiree passes and then they had an eligible spouse or domestic partner that was receiving the benefits and they pass, the only benefits that would go to the children, if it, and this is just what the way I process it, there would be no death benefit because the death benefit for the retiree would have already been paid to the eligible spouse. And it would only be if there was the money that they put in left over, right? So, so when you open up your UC raise, it gives you that amount of money. When it tells you your tier, how much you've input. Are you getting where I'm going on this,
Yeah,
Don?
I know where you're coming from. The
Yeah.
unpaid UCRP contributions would go out to the children. That is pretty rare for the most part. We
Yeah.
typically eat up the UC contributions real quickly, but basically, children, a child, only one person can be named contingent annuitant, but children do qualify. I'm trying to scroll back enough. Eligible children. But that's a little bit rare and it's a limited benefit. Almost, we go. So if this is the question, children can be entitled to the 25% eligible survivor benefit as long as they're under the age of 18, as long as they're under the age of 22 and they're in a full-time student, or if they're an adult disabled dependent, then they would be eligible for this 25% benefit. So make believe again, the employee passed away, they had a spouse who was eligible, then the spouse passed away. Children can be eligible for that 25% benefit as long as they meet this criteria of under the age of 18, 22, or an adult disabled dependent.
And just to reiterate, they're asking if the contingent annuitant dies before you, can it be changed? And the answer
It is
is no.
irrevocable.
Yeah.
Correct.
Okay. So let's see. Adult question death prior. Do you need to? So, question to death prior to retirement. Do you need to submit a retirement form, or is it automatically done?
No, that's policy. So, let me see. I think that's here we are. So death while eligible to retire, that means again, you're eligible to retire. You're either 50, 55 or older, and you have 5 years of service credit. So you can retire, but you didn't retire and then you died. So what would happen is the day after the death, the retirement would go into effect and the spouse or domestic partner would get option A, which I'll go back a couple of screens. Option A is the highest benefit available. So under death while eligible, retirement goes into effect the next day. Spouse or domestic partner gets the highest benefit available, option A.
So this is probably, I mean, you may have a good idea about this, but I think it might be a higher level than all of us as well. It says, are monthly pension payments guaranteed or can they be changed due to funding?
No, it's a guaranteed benefit. This is a formula. Your pension is based on the age, your service credit, and your salary, HAPC. This is not changeable. It is a guaranteed lifetime benefit, um, not subject to change. The only change that happens is it increases every year. There's a cost of living adjustment.
Okay. And we get this one usually too. Can a living trust be designated as a contingent annuitant?
And the answer would be no, no, no. Um, a contingent annuitant has to be a person. It has to be a person who will eventually pass away because this is a payment of it's a lifetime payment to that individual. And eventually it has to end. The payment that goes to that individual, that person may have, I'll say it goes over my head a little bit, but they could have a trust that is the beneficiary, but the trust cannot be named the contingent annuitant. It has to be a person.
All right. So this is around our annual reviews. If I get a raise, which would normally start on 7/1/26, but that's the day I retire, will I get that higher income with any sick time that I've accrued to add to my years of service? In other words, is it beneficial in any way to do a final review in my department?
No, so in this case, if you're going to get a raise July 1st and you retire in July 1st, in theory, you separated in June prior to the raise. But um, again, we have to keep in mind that we use the highest average 36 months. So, and I can't imagine anyone doing this, but so you got a raise in July and you say, well, I'm going to stay 3 months to benefit a little bit from the increase in salary, that's only going to affect 3 out of the 36 months. So we use the highest average 36 months. And if you stayed 12 months going forward, and decided to go 1 year later, then it would affect a third of it, 12 of 36 months. But if you are retiring July and that's when the increase goes, you would have separated June and retired July 1st. The raise would not affect the retirement.
So this is a question probably for the retiree center. Is there any way that longtime staff can apply to retain their UC Davis email address after retirement? So those with emeriti status will retain their UC Davis email address. And so it's mostly faculty and academics that would fall into that category. Staff employees, we do lose our email address. There is like occasionally options if you do, like maybe you join an association, like the Retirees Association, um, and you're going to do some work on behalf of the association, there's a possibility that you could get that reinstated, but it's only for, it's a limited amount of time. So there is no way to apply to retain that. It would only be if you're going to be doing some work on behalf of the university in retirement. And those are also very carefully looked at and reviewed. So, as a rule, the answer is no. Okay, have a reciprocity question for you. And so I resigned from Valley Med on March 2021 and joined UC Davis on June 2021. Does reciprocity rules still apply? If
Yeah.
yes, what do I do?
Okay. So in this scenario, you went from one place to the other within 180 days. So you are eligible for reciprocity. I would Google at UCNet reciprocity, which will take you to the reciprocity fact sheet. At the end of the reciprocity fact sheet is a UBEN 156 form. And basically, you have to complete the UBEN 156 form or U156. And there'll be mailing instructions, or it goes to the Retirement Administration Center in Oakland. You could, once it's completed, you could even do it at UC Rays. You could image the document, PDF it, and send it as a secure message and attach the form, or you could fax it as well, mail it. There's various options of getting it to the Retirement Administration Center. But to qualify, you have to, just to recap, you have to be going from one place to the other within 180 days. But the form didn't need to be completed within the 180 days. So you could do it right now, so to speak.
Okay, so let's see. So what happens if you're being laid off and choose to retire afterwards?
I would say if you are being laid off, you probably, I meet with a lot of people who, not that a lot of people get laid off, but if you are being laid off, we could probably set up a time to meet, because there are pros and cons of retiring versus not retiring. And that really is specific depending upon the age. So I would say reach out to me, D Goldberg at ucdavis.edu, and then we could talk about it, and we could definitely go over your options and the pros and cons.
Okay, so this is the first one we've got on the date of retirement. So if I retire on 7/1, my last day of work is June 29th.
Yeah, I would go with that.
For 1976 tier and safety members, is that right?
That would be correct. You have to miss 1 day of work. I haven't looked at the calendar, but June 30th, I believe, is a work day this year. So you have to miss 1 day of work. it could be June 29th. It doesn't, keep in mind that you have to miss at least one day of work. If you, hypothetically, your last day of work was June 28, 27, 26, that also qualifies you. But the main thing is you got to miss one, you have to be inactive, missing at least one day of work, which this year, the last day would be June 29th.
So there's a question I had put out while you were talking, Don, that Kim Becker of Fidelity has scheduled a couple of dates in our Davis office, and we've got still some time slots available for her on January 13th, which is next Tuesday. So if you're interested, you can give us a call. And then also on February the 24th. And the phone number to call to schedule that is the Retiree Center at 530-752-5182. And we don't have like 30 appointments available, but we probably have about 10 between those 2 days. So if you are interested, give us a call. We'll try to get back to everybody on Monday for those because we will be in sessions all day today. So I don't know if this is the right time for this, but maybe you can do a quick synopsis of this, Don. Can you explain the difference between modified 2013 and 2013/2016 tier? This person started in 2015.
Oh yeah, yeah. It's basically two different main differences. The 2013 modified tier, the age factors are 50 and 60, meaning the earliest you could retire is age 50 in the modified tier, and your age factor has been maximized at age 60. In the 2013 2016 tiers, the earliest age you could retire is age 55, and your age factor is maximized at age 65. So that's one is the age factors. And the 2013 modified tier has a lump sum cash out provision. The 2013, 2016 tiers do not have a lump sum cash out option. So age factors and lump sum cash out.
So this is about the retirement date also, and July 1st is my retirement date. Would 6/29 be last work day? Also, can you do this as vacation?
Correct. And when I say correct, in theory, all vacation has to be approved through your department. But people, yeah, it doesn't have to be a in-person work day. I was going to say too is make believe some people did not attend this presentation today. And what the Retirement Administration Center does is if they see incorrect dates, say for instance, somebody who's in the 76 tier safety tier member had a retirement date with a June 30th separation date, they would actually reach out to the employee and say, you may want to consider separating on the 29th so you could qualify for the inactive COLA. So even if you didn't know or you forget about the right dates, there is a safeguard that the Retirement Administration Center will red flag those that are eligible for the inactive COLA and have not pick the right dates. But with that said, you want to pick the right dates because the safeguards probably need safeguards themselves.
Okay, so really there's a question, is the chat and Q&A of this meeting included in the recording? And yes, it will be included in the recording for everyone. What date range is the HAPC calculated on? Is it a calendar year or fiscal year, or is it based on your hire date?
It's 36 months. And basically, the HAPC is a rolling, regardless of calendar, it's your highest average 36 months. So make believe you retired April and your last 3 years were your highest. It would be from April going back 36 months. So it rolls and it updates pretty much every month your HAPC increases, assuming that you're in the highest earnings of your last 3 years. If your HAPC was from 10 years ago from a different position that you no longer have, then your HAPC is not changing. But for most people, the HAPC is typically in their last 3 years.
Okay, so if I retire July 1st but turn 62 in August, am I losing out on anything?
No, no. You see, I don't know what retirement tier person's in, but that doesn't even really matter because just make believe they're in the 2013, 2016 tier. The only thing you would have lost out on is 1 month of age factor. Um, and if let's just say the 1976 tier, no way, I was going to say in the world, would you not retire July 1st because you're giving up, in theory, roughly 4%, the 2% inactive COLA, and then because you chose an August 1st date, we'll say then next year you're not retired 1 full year and you would not be eligible for the 2% retirement COLA. So there wouldn't be it wouldn't make sense to get 1 more month of age factor. And I'll explain that too. Um, each and every month, assuming you're under the age of 60 or 65, depending upon your retirement tier, your age factor changes each and every month. If you were born July 15th, then the 15th of the month, it is changing each and every month. So the difference in that scenario between being 62 in August and retiring in July is instead of being 62, you're retiring at 61 in 11 months. It's only 1 month of age factor. On the estimates, they show whole years, but it changes each and every month age factor.
Okay, so there is a note again, if I die before setting up the retirement, once again, that's policy that will be taken care of. Just, so that came in again after. So what Don was saying is that if you pass away before, UC automatically sets up the retirement and would they would make contact with this spouse and everything, correct?
Yeah,
Is
yeah, but there's a big caveat in there that you have a spouse or domestic partner. If they're ever, and I've taken these phone calls at the Retirement Administration Center, um, where there are UC employees who find out they're terminally ill, and I definitely remember one case very vividly back in the day when I could do the retirements, and the person was terminally ill, and he told me he only had a couple months to live. And pretty much while we were on the phone, I created the PRP. We did a lump sum cash out option. I sent it over to him, and he signed it. And once UC receives the signed election, even if a person passed away the day after the signed retirement election has been made, they would honor the retirement election. So the death while eligible is a great thing, not the death, but that there is this policy where the spouse gets the highest benefit available. But if there is a case where there is not a spouse, and somebody was terminally ill, you would want to reach out to us, as soon as possible, and pretty much in almost all cases, probably choose the lump sum cash out or name a contingent annuitant, but definitely get the retirement done a lot sooner than later because there is no provision for those who don't have a spouse or domestic partner. That was a little bit complicated.
but good information.
Yeah.
Um, so this is a question. I think a lot of people are calling me right now to set up appointments. Kim, my my Zoom phone keeps popping up. If I plan on retiring in February 2027, when is the best time to submit the paperwork?
Yeah, I would say the earliest you can submit the paperwork is 90 days in advance. So January, December, November. So you should go, you would be able to go online as of November 1st, 90 days in advance of the retirement date to start the retirement process at UC Rays.
So this is one about a lump sum. If you're trying to get the lump sum, do you have to wait to retire on July 1st if you were in the 1976 tier?
Yes, yes. I'll go back roughly 20 years ago, but I remember asking this question to my manager, and I said, why, if somebody takes the lump sum, does July 1st, it doesn't make any difference? And he goes, yes, it does. So it does because it increases the HAPC by 2%, which increases your lump sum by 2%. So even if you are taking the lump sum on July 1st, um, and you are in the 76 tier, you would definitely still cost of living adjustments, retirement COLAs do not matter, but you would qualify for the inactive COLA, which increases the HAPC by 2%, which then increases your retirement by 2%.
Okay, so a question came in about Fidelity, and it says, do we still have free access to Fidelity consultants after retirement? And the answer to that is yes, you do. And so as I, put in the chat or Q&A, I can't remember, Kim Becker is with Fidelity, and Spencer Richards will be coming back hopefully in the next like 4 or 6 months and they both are our representatives for UC Davis. And you can reach out to them at any time. Currently, Spencer is on leave, but Kim is available, and they're available um, for us as employees, but also in retirement. And we do a lot of programming with them for our retirees. That we do like special Social Security talks, all sorts of different things with them throughout the year. So I also encourage you to sign up for our newsletter, which is on our website, retireecenter.ucdavis.edu. Once you retire, so that you can stay involved and be able to get all of that information that is beneficial to you as a retiree with UC Davis. Let's see. So once again, the inactive COLA is only for 1976 tier and
Safety.
safety. Okay.
Right.
All right, let me go look here in my chat, see what else has come in. Lots of thank yous to you, Dawn.
You're welcome.
And I don't know if you know the answer to this. I'm thinking you probably have some knowledge. I was recently included in UPTE Union. Does that affect any of this?
Yeah, it depends on the specifics. If you are changing from it depends when you were hired too. I would say reach out to us at benefits@ucdavis.edu because it can, but it just depends on the specifics.
Yeah.
Now,
Does
Julianne, I do got something. Usually we always get this question and I hesitate to bring it up, but I'll bring it up because we have the time. Okay. So make believe you're retiring July 1st and you have a lot of unused vacation hours. The question is typically people ask about vacationing out. So what that means is that you're still retiring July 1st, you're still separating, we'll say June 29th, but instead of working up until June 29th, you stop work, say a month earlier, and you use vacation time. That is called vacationing out. That is something that people do. It needs approval by your department. to vacation out. Um, but and this is just a personal call. I don't like it because I'll explain. So you're retiring, so you're not working anymore. Make believe you work here 20, 25 years. If you can make it one more month, you made it 20 years, 25 years, whatever it is, you can make it one more month and then get paid out on that unused vacation hours and use it for a great vacation. Instead of stopping work one month earlier, you make it till the end of June roughly, and then you got that extra money to fund a great vacation instead of vacationing out. Part two of it is hasn't been so now you didn't vacation out, which is good, and you're going on a nice vacation using your unused vacation hours. People, and I've heard this many, many times, they go, I don't like getting paid out on my vacation because they use a higher tax rate. And that is true. So the unused vacation pay that is paid out on your final check is taxed differently than normal wages. So now we're getting a little bit complicated, but what one can do is prior to the last paycheck, say you're paid monthly, you're retiring July 1st. Um, and this is going to be your final check. So as of June, you could go in there and you could change your Fidelity contributions to a maximum of, say, 70%. So in theory, that final check 70% is being rolled over to your retirement savings programs, therefore not being taxed at the higher rate. But if you were to be paid out on this um, at the higher rate, for me, I don't think it matters, and I'll explain. Because at the end of the year, if we pay taxes. If we paid too much taxes, we get a refund. If we paid too little taxes, we owe them. And if by chance, because you got paid out this vacation pay and you paid more in taxes, then the odds are you're going to get a refund and you're not going to owe. So in the end, it kind of works out, but it's definitely a personal call.
That was a good one, Dawn.
Okay.
So there is a question about, it says, what do you mean you can decide not to pay California taxes if you move out of state? Why would someone? And then the last part of that question is, are you eligible for the legal plan after you retire? I can answer that. Yes, you are. Do you want to explain the
Oh
California
yeah,
tax
yeah.
thing?
I think that's a good one. Um, so now you moved out of the state of California and you changed your address at UC Rays, and you would think they're not going to take out California state taxes because you changed your address and you're not in California. But they will unless you elect and go into your tax withholdings and say, do not withhold California state taxes. So if you are leaving the state of California, you actually have to go in there and say, do not withhold California state taxes, or they will continue to take out California state taxes, even though you live in a different state. I think that explained it.
Yep,
Okay.
I think so. Okay, I'm just looking here. So, on what date can I initiate retirement in UC Rays if I'm retiring this year on July 1st? And what is the
April
last
1st.
day I can initiate retirement before July 1st?
There is no last date. Let's go back to the first one. The earliest is 90 days in advance, April 1st. You can literally initiate retirement June 29th. The main thing is you have to stop work. Um, you know, you can't erase the fact that you may want to retire July 1st and separate June 29th. But if you went to work on June 30th and July 1st, they can't make believe that you weren't there on that day. So therefore, it's not so much the last day to initiate. More importantly, you got to make sure that you do stop work, assuming you're in the 76 tier safety tier on June 29th, and then you could qualify it for the inactive COLA. But you can initiate the retirement June 26th. The problem with that, it doesn't affect the numbers. It just means the later you start the process, the later you'll get your first retirement check. But in the end, once they do process your retirement, it would be retroactive to the July 1st. It just would mean probably a gap of a period of time between your last UC Davis check and your first retirement check.
So, there's a few questions coming in about some of the insurance plans and stuff, and I'm really going to leave that for Garen and Nick next week because
Okay.
that is going to be their focus. I know you can probably answer a lot of them, but I also think that it's important that um, it comes from them as part of their session. But there is another one. Are there any considerations to be made for living outside the United States upon retirement?
Yeah, that there's two things. Health insurance will be answered next week, but the one thing for those who live abroad, you have to have a U.S. bank account. So make believe you go to Spain, random. You couldn't have a direct deposit to a Spanish bank, but what you would have to do is keep an American bank for direct deposit and then transfer it from the U.S. bank to the bank in a different country. That would be the only consideration. It would affect your health insurance. You would need a PPO, and they'll talk more about that next week. But from a dollars perspective, pension wise, you would want to have keep a U.S. bank for direct deposit purposes.
Let's see, got just a couple more. And this one, um, I think I know the answer, and I'm pretty sure you will. Can we defer receiving the receiving Social Security with our UC retirement monthly income if we want to wait until we are at our Social Security
Oh, yeah.
age?
Yeah, I would say it's the right hand and the left hand. We'll call you see the right hand. You could start that and not start at, Social Security to a later age. Definitely.
Hmm.
I'll say this too about the UC retirement. The UC retirement, the pension is not affected by pretty much anything, being that it's a formula. If you collect Social Security, that does not affect the retirement. If you go work for another company, that does not affect your UC retirement.
This is for somebody who's thinking of retiring at 5 years. Um, 65 in March. Been working at UC Davis since 2021, and he wants to have an early retirement of 5 years. What is the exact date of my retirement do you suggest? Where do you suggest to get all the benefits?
Okay. So one thing that I would say is you don't want to estimate when you're going to have 5 years. I would say you want to see it before you retire. You want to be 100% confident that you are going to reach 5 years. And then once you are 100% confident that you are going to have 5 years, you could start the process 3 months in advance of that retirement date because, okay, this is a good story. The personal retirement profile is very, very accurate, but it's not perfect, especially as it pertains to service credit within fractions. So years ago, when I was at the Retirement Administration Center in Oakland, I back in the day when they weren't doing it online, we would get these forms come in, and I had a form come in and I sent out the retirement package, and this was a U coincidentally, because we did it for all of UC, a UC Davis employee. And then when they did the final calculations for this UC Davis employee, she came in at 4.9997. So she was not vested. Again, she was at 4.9997. I had to call her up and tell her that she was not eligible for retirement benefits because she didn't have the 5 years of service, but a happy ending. She did work for UC Davis. She did have good employees. And eventually they brought her back for 1 month. So she was able to get the additional service credit and make it to the 5.0. So punchline is you want to make sure for sure that you're over 5 years, and you don't want to make it by a nose. You want to definitely be over by an undeniable amount because again, there's no pension for 4.9997 years. It has to be 5.0 or more.
Okay. Sorry, I'm writing also. Okay. And let me just go back here. See what I think. Questions regarding age 78 in the annuity slide. What is the maximum annual payroll deduction limit for the applicable retirement account? Age 78 in the annuity slide.
I think that was saying, I got to find that. I'll try to, yeah. I'll start talking while I'm toggling if I could
Okay.
do, do that. Basically, it's saying something along the lines that instead of trying to manage your money on a regular basis to make sure that it lasts a lifetime between, I think it was 62 and 68, you can convert that into an annuity that had a lifetime income guaranteed. Was it at age 78?
Yeah.
Yeah. Well, yeah. So instead of trying to make sure that your money lasts a lifetime, you just basically, I don't know the right words, but you hand it over, you annuitize it to a institution, whether it be Fidelity or another financial institution. And what they'll do is guarantee that you have a lifetime income. Okay. So yeah, basically they're saying you have this option between the ages of 62 and 69 to convert a portion of your retirement savings program into guaranteed monthly payments that will start at age 78. Yeah.
That's
That's yeah, an interesting one. Yeah, I'll leave my personal opinion out of it, but that is an option.
So just a couple more questions before I think we sign off is, can we purchase service credits to cover any unpaid FMLA?
Yeah, yeah, that if you are on a approved leave of absence, you can do a service credit purchase to buy back the time that you were on the approved leave. The one thing that I would say is if you were on a approved leave, you want to do that as soon as possible, ideally before 3 years, because it tends to be advantageous within 3 years. After 3 years, when they do the calculations for the service credit purchase, it's done at a cost neutral basis, meaning that they'll determine the cost for the service credit purchase based on the benefit, and it's done at a cost that's not negative to the UC retirement plan. Within 3 years, it tends to be beneficial. If your leave of absence was outside of 3 years, it may not be too beneficial because, again, it's done at a cost neutral actuarial basis.
So in the monthly retirement income options, can the eligible survivor be the same person as the contingent annuitant?
Yes, definite. And I could tell a story that's not funny, but I guess it's not funny. But um, when I was at the Retirement Administration Center, and this can be confusing because there was a person who both the spouse and the retiree, they both worked for UC in this story. And during the husband, he retired first and he named his brother contingent annuitant. And he totally was not understanding it because he was thinking of this more as a secondary beneficiary. Like if my wife dies, I want it to go to my brother, but that's not how the contingent annuitant works. So he named his brother contingent annuitant. Then his wife retired years later, and she learned what the contingent annuitant was, and she was very mad at the husband for not naming her the contingent annuitant and naming her brother, his brother, contingent annuitant. So the contingent annuitant definitely can be the spouse or domestic partner, the same person who is the eligible survivor.
All right. Let's see. Do you need to retire within 120 days after separation to qualify for health insurance?
Correct. Correct.
Okay.
Yes, Garen, I'll say that's for next week, but um, pretty much that's everybody does that. Most people statistically will go back, will retire July 1st, separate June 29th, well within 120 days. I don't know any reason for the most part why, given the option, you would not retire and wait beyond 120 days. So and make yourself ineligible for retiree health.
So yeah, there's a lot of questions about the vision coverage after retirement, and it is an option for retirees to get the vision coverage. Garen will go into details about that because it's a little bit different than like our regular health coverage and how that works in retirement. So he and Nick will go over that next week. Um, and then let's see. How can I get my service years in writing? Wanting to ensure that the years service years exceed 5 years. I do know there's a form you can submit. Do you know about that,
Yeah,
Don?
skip it. No. Yeah, there's when in question about it being correct or not. It's a very complicated, process involving payroll records, and usually it's correct. Basically, going back to the 5 years, you could see your service credit at UC raise. So every year, um, you, well, every month, sorry about that. Every month it updates, typically at the end of the month. I would say usually after the 20th, it will update for the previous month. So it updates once a month. We're in January right now, so December's would not have updated. It would show right now if you went to UC Raise your service credit as of the end of November. But basically, what you want to do is to look at the UC Rays website to determine where you stand service credit wise.
Okay, let's see. Once again, lots of thank yous. So there is a question, how long after retirement date do the pension payments start depositing?
Yeah, I would say typically a month is the normal, but there's so many variables. It depends on your retirement, how complicated it was, how quickly you submitted your retirement election forms. But basically, the rule of thumb is if you did retire July 1st, your first retirement check would be August 1st. If there was a delay, let's just say there was a month delay and you would pay, it got processed in September, then it would be paid retroactive to July 1st.
So I just want to like throw something out there too. When you do start the process, say you're going to retire on July 1st, you can start the process as early as April 1st. You need to go back into UC Rays and look at things, period, not like once a month or once every 6 weeks. You want to really look for that first like month, almost weekly, because they may be asking for something, or maybe there's questions. Because they only send you messages via UC Rays. They don't send you emails if something's amiss. So it's really important when you do start your process, and I know this because I've helped several people with the process, and you want to make sure that you stay on target, because if you don't see something for a month or 6 weeks, it could delay when you get your pension payment, because they need all the information before you can actually go into the calculation piece of your retirement. So really important that you just look at it. It doesn't take very long, and once you get used to the system, it's really quite easy to maneuver around it. But I just highly recommend that you always take a look, especially those first few weeks, just to make sure they're not saying, we didn't receive this or we can't read this. There are questions that come up. So
I'll continue with that. So at UC Rays, when you're going through the retirement process, when you log on, it's kind of hidden. You have to scroll all the way down, and there's a retirement tracker that will track exactly where you are in the retirement. And as Julianne said, you do want to monitor that to make sure things are progressing. But the weird thing is once everything has been finalized, the retirement tracker goes away, which catches people off guard because they've been looking at this retirement tracker and now it disappeared. And it's not intuitive to say, oh, everything's great. If anything, you're thinking the opposite. What happened to my retirement? So that is something to keep in mind, that you can track it at UC Rays at the retirement tracker. And then all of a sudden, when it disappears, that means you've been set up and the process has been completed, but it doesn't show you on the retirement tracker that everything has been completed.
and usually when the tracker's gone, the look of your UC raise changes also, because you go from being it using UC Rays as an employee to and all of a sudden and this just happened yesterday with one of our recent retirees. It looks very different. But that's also where you'll receive, if you did everything online, that's where you'll receive your notification of retirement, the confirmation, and you can print that out and have that. So, um, okay, so we're going to talk about the COLA one more time, Don. I've heard
Yeah.
about having to retire before July 1st to maximize COLA on retirement. Does this apply for 1976 tier only? I'm in the 2013 modified tier.
Okay. So yeah. Um, Keeping in mind that you do retire July 1st, you separate before July 1st, late June. But for those who are not in the 76 tier or safety tier members, basically it just means you don't have to have that 1 day gap. You can work up to June 30th. That can be your last day and retire July 1st. For those in the 76 tier, safety tier members, you have to miss 1 day of work, which this year would be June 30th, 1 day or more of work being June 30th. Then you become inactive, and then you qualify for the inactive COLA. Okay, I'll throw this out there too. So you did that. You retired, you're in the 76 tier, you retired July 1st, you separated June 29th, and then you get your confirmation letter. It will say your next COLA, it talks about when your next cost of living adjustment will be. It will say July 1st, 2027. And then people get mad again because they say, what happened? I was supposed to get a COLA. I separated June 29th, like that guy said. I retired July 1st, and they don't show my COLA because it's already included in your retirement calculation. So if you retire July 1st, separate June 29th, when they process it, they've increased and given you the inactive COLA. So in your confirmation letter, it will say your next COLA is July 1st, 2027, because you've already received the inactive COLA.
Okay.
Probably forget it. It's there's so many different things involved in the retirement. And if people remember this little fact, 6, 7, 8 months later, that would be great. But we're here if there's any questions about that. Again, we'll have those benefit help desks. Julianne's part of, Sadesh is part of it, Fidelity, Kim Becker's part of it, Garen's part of it. So as you go through the retirement process, we'll be here to answer any questions you have.
And this will be our last question. We're going to sign off. Does your sick time accumulate towards retirement years if not used?
Yeah, oh yeah. So unused sick leave counts towards retirement service credit. And basically, how they determine what you get credit for is unused sick leave gets divided by 2,000 hours. Make believe you have 1,000. Divide that by 2,000. That's a 0.5. That increases your service credit when you take the monthly benefit. If you do the lump sum cash out, it does not calculate in sick leave, but if you take the monthly benefit, it counts. Every hour is accounted for, and the unused hours get divided by 2,000. And that doesn't change your retirement date. That doesn't change your separation date. It's just added to your service credit. And you can't stop work earlier. You can't sick out and call your boss and say, I'm going to be sick. Um, April, May, and June, you could feel it. You got a cold and it's going to last for months. You can't sick out, but you could vacation out, as we talked about, but does not change your separation date or your retirement date.
All right. Well, with that, we're gonna close out for the day. I know there's some questions we didn't get to, but I will be sending some links that you'll be able to go in and find these questions. I'll send like the retirement handbook and stuff. But thank you all for staying with us. And Don, Sudesh, Amanda, thank you so much for being here as our panelists, and Don for answering all of these questions. And as I say this every year, I always learn something new every single time. So I appreciate that. And I look forward to seeing you all next week for the healthcare, which is a really good one as well. And I just want to throw out there that every single one of these is really important for you as a retiree. Some people say, oh, I don't need number 4 because I've got things figured out. They're really good at making you think about what you're going to do. All of a sudden, like for me, if I were to commute to Davis every single day, it would, that's 10 hours of my time just driving on top of all the hours I work. I find every single one of these sessions is such a huge benefit. including number 4, that really helps you to think about what are you going to do with all that extra time. So keep it in mind. Hope to see you all next week. Don, Sudesh, hope to see you guys soon. We need to all get together.
Sounds good.
Anyway,
Have a great day, everyone.
bye everyone.
See
Thanks.
you next week.
Thank you.
Okay.